It is the biggest GDP drop since the pandemic. Gross domestic product fell at a 1.6% annualized pace for the second quarter of the year. Let's go to Sal Guatieri on this, Director, Senior Economist at BMO Capital Markets, to talk about it. Thanks for joining us today.
You're welcome.
So is this all tariff related?
I'd say pretty well that is the case, yeah. And that's why Canada's economy was basically the biggest global casualty of this trade war. You had exports collapsing 27% at an annualized rate in the quarter, and business spending on machinery and equipment plunged even more. Those are pandemic-like declines in activity. No mystery why. The tariffs on motor vehicles, steel, aluminum, those were the real weak spots for exports. And Canadian businesses, because of all the uncertainty about trade policies, would things get worse, would they get better, really just put plans to invest on hold. And so we saw a big collapse in business investment as well. Now, that said, there were a couple of bright spots. One, residential construction did rebound quite nicely. We are seeing a pickup in home sales across the country from depressed levels, but at least moving in the right direction. More importantly, Canadian consumers spent at about a 4.5% annualized rate in the quarter. So we're seeing some signs that the Buy Canada movement, for example, is really supporting the economy, providing some offset to that hit to exports and investment. We saw that in the industry data. Some of the areas, tourism-related areas, arts and entertainment, for example, hotels, restaurants, very strong activity in those areas. We also saw good strength in retail spending. So Canadian households really did help insulate the economy from part of that trade shock. The other good news is that we did see GDP increase, albeit slightly, in July. So providing a bit of a positive start to the third quarter, where we do expect GDP now to increase in that quarter. So it does look like Canada will avoid a so-called technical recession and will avoid contracting for 2 consecutive quarters.
Okay, so let's get a little bit more into it, if you don't mind. So the decline in exports, we all expected, we knew that was coming. The slower investment is no surprise as well. But because some of the tariffs have been shaken out, and we don't have a specific deal with the U.S. yet, but because some of the uncertainty maybe has passed, a greater uncertainty, do you expect that the spending by businesses to improve in later quarters?
Well, it will improve, but again, from very depressed levels of business spending in this country. There are some encouraging sides. Both governments are in talks now to try and reduce those sectoral duties that are hammering the auto, steel, and aluminum industries here in Canada. That would mark big progress if we can get some kind of deal to reduce those tariffs. But the big unknown and big uncertainty for Canadian businesses is what happens to the free trade agreement, the USMCA, because that so far is providing to most businesses a dramatic out in this trade war, because most goods sent to the U.S. are still duty-free. So we have to make sure that we re-sign that deal and we continue to send most of the products from Canada to the U.S. duty-free. Until we get some clarity there, and that could take months, Canadian businesses, I think, will be quite reluctant to really open the floodgates on spending. Again, a lot of the economic support will fall on the backs of Canadian households.
Yeah, consumers were spending more, as you said, and you think it was likely more people spending money locally because they didn't want to spend it or send their money to the U.S.?
I think that's a big part of the strength in consumer spending, because we know that fewer Canadians are traveling, especially to the U.S., and they're probably redirecting that spending domestically. And we saw on an industry basis quite a bit of strength in the tourism-related areas. Arts and entertainment, restaurant spending, hotel spending, for example, all were quite strong in the second quarter. So that really helped. And as well, generally, consumer spending was strong. We saw that in retail spending, for example, in the quarter. And that's simply a reflection of, yes, employment growth is slowing, but the unemployment rate is not too high in Canada. We really have not seen a lot of mass layoffs in the Canadian workforce. Those layoffs have been very concentrated in the auto industry, steel industry, for example. So most Canadians who were working before the trade war are still working, still drawing a paycheck. So they're still spending, and that is what's providing some support to our economy.
The Bank of Canada, of course, will look at the rate of inflation when trying to make a decision, but how will they factor in this lower GDP?
Well, the Bank of Canada was anticipating a weaker GDP. In fact, the estimate came in very close to the Bank of Canada's estimate. So I don't think this report will really move the needle as far as pushing the Bank of Canada to cut interest rates in September. What the bank will need to see now is some evidence that core rates of inflation are subsiding. We'll get the August CPI report. Hopefully we'll get evidence of that. But as well, we'll probably have to see further signs of weakness in the labor market in Canada in employment. It has been weakening, but perhaps not enough to push up the unemployment rate further. So until we get that, we now believe the Bank of Canada will probably hold to the sidelines again on September 17th before cutting interest rates at the October announcement date.
Sal Guatieri is Director, Senior Economist at BMO Capital Markets. Thanks for your time. I appreciate it.